Then we have the practice question. Let's do it. Dees Harbor Group, DAG Inc., is a large multinational investor in your timber and forest located at the North and South American continents. DAG Inc. is the general partner of DAG LP, a limited proprietor that is a 100% owner of timber and forest asset. DAG LP is controlled by DAG Inc. All right. And its limited partners, DAG LP is controlled by DAG Inc. and its limited partners. Limited partners own a 20% stake in the partnership, while the DAG Inc. holds the remaining majority stake. DAG Inc.'s shares are listed on stock exchange in the US and Canada. DAG Inc. is organized as a special corporate form available in its jurisdiction, which it does not pay corporate income tax so long as it distributes all of its net income as dividend to its shareholder and complies with other conditions in the current and past fiscal years. DAG Inc. has complied with all these conditions. DAG Inc. shares are owned by various members of D family who hold several key senior management positions at DAG Inc. and DAG LP, and collectively they own 30% of shares of DAG Inc. The remainder of DAG Inc. are owned by a variety of individual and institutional investors. None of them own more than 5%. The following diagram shows the organized structure of DAG Inc. and LP, right? So let's see the structure. Long, lengthy question. So this is the structure which we are getting. The timber and forest asset that come into your DAG LP, then it is subdivided into DAG Inc. and limited partners. DAG Inc. has D family members and outside shareholders. Now the question which is there is what percentage of timber and forest asset are effectively owned by the D family members in this scenario, right? See, I'll try to answer it. See, this long question, you have to cut the fluff, right? You have to come to directly to analysis, right? So D family, right? Right. When you talk about D family owns your 30% of your DAG Inc. Right? And DAG Inc. owns 80% of DAG LP. Right? So basically, your DAG LP, right, owns the asset. Right? This is given in your diagram also. Now, if you have to take the question asking what percentage of timber and forest asset are effectively owned by D family, right? So we are talking about D family members, which is this, right? So effective ownership is what, right? Simple point is that you directly go that I have written here DAG Inc. own 80% of DAG LP. DAG LP owns the asset. So, and D family owns 30, right? So the relation between this and this, right? DAG Inc. and D family members is 30%. Relation between DAG Inc. and DAG LP is 80%, right? So, and idea is just multiply it, right? 80.80 into 0.30, right? This 0.24, 24%. Very straightforward, very easy. Yes, you have to take out the information which is given in the question, okay? All right, then we have more questions. Which of the following best describes the taxation, right? Which of the following best describes the taxation of DAG Inc. and your LP? See, when we read the question, it was clear that DAG Inc. is a special corporate form, pays no corporate tax, right? If you go back to the question, right? DAG Inc., right, is a special corporate form, right, which does not pay any income tax, right? This special corporate form available does not pay any corporate income tax, right? So this is given in the question, right? So that is a relief that, okay, fine, we know this much, right? Now, income is distributed as dividends, right? So let me write it down if it has to be made, right? DAG Inc. special, all given the question, guys. Corporate form, right? Pays no corporate tax. Income distributed as your dividends. Okay. Then you have DAGLP. Okay. And it's a pass-through entry. Okay. So the correct logic here is that shareholders of your DAG Inc., right, pay tax on your dividends, right? And partners of DAG LP pay tax at your personal level, right? So that's the whole idea, because income is distributed as dividend. So DAG Inc. shareholders pay tax on your dividend, and your, since DAG LP is a limited partnership and your pass through, right? So here partners of DAG LP pay tax at personal level, right? So that's what it is. So this is correct. This is okay. DAGLP pay tax on pre-tax income? No, DAGLP pays on your what? DAGLP pays tax at your personal level, right? So this is wrong. DAG Inc. Pays tax based on pre-tax income. This is also wrong, right? So they pay on dividend income. Okay. Then you talk about the description of your DAG LP and your DAG Inc., right? So again, if you go back and see the question, right, it is given that DAG Inc. is a general partner of your DAG LP. General partner has unlimited liability. DAG Inc. shareholders has limited liability. So that's what we are getting. So neither DAG LP or DAG Inc. is managed by a majority owner. Wrong. DAG Inc. has limits to its ability to raise new capital because of dividend requirements, corporate form. Wrong. DAG Inc. faces unlimited liability as the general partner. Yes, general partner has unlimited liability, that you have to remember, right? And DAG Inc. shareholder, you know, as a corporation implies the shareholder face limited liability. Yes, that's also true. The shareholder face limited liability, right? So this is C. Okay. Be careful. Easy questions, but tricky, right? Next one is your question number 4. Here, what is the significant difference between the limited partners of DAG LP and the outside shareholders of DAG Inc., right? So the significant difference between the limited partner of DAG LP and DAG Inc. is that limited partner of DAG LP no voting rights in the DAG Inc. and cannot replace the board, right? Outside shareholders of DAG Inc. have voting rights and your can influence your board decision, right? So ability to vote and replace members of DAG Inc., right? What is the significant difference between the limited partners of DAG LP and the outside shareholder DAG Inc.? Right? That outside partners have voting rights, outside partners can influence your board decisions, right? Which your DAG LP cannot do because there is no voting rights of DAG Inc., no voting rights of DAG LP in DAG Inc., and you cannot replace your board, right? So remember that as well. Very tricky. The next question here is, which of the following rationales would be most consistent with the D family choice to create this complex organized structure instead of simply organization or organizing as a limited partnership? Basically, the idea is the D family wants to control the management, right? And they have only your 24% effective ownership, right? And they want to control the management with only 24% effective ownership while maintaining your limited liability, If they have gone for a simple limited partnership, that would require higher ownership, which they don't want to take. That would have required unlimited personal liability. That is also a no-go, right? So you want to have management control without the need for majority ownership by the family while also maintaining limited liability, right? So that is why this complex structure you have. Overall, what you need to understand is that if it's a private company, it's illiquid, less regulation. If it's a IPO, it's a capital plus compliance. The direct listing, it's a liquidity only. SPAC is fast public access. And when you go to such kind of question, your LP plus your corporation combo, it's all about LP is all about your control, limited partnership, and corporation is about your limited liability, right? So that's what you need to understand. Okay. So keep that in mind, guys. I think that's yeah, these are the answers. This is what we found 24%. That's perfectly fine. So that was great. Then it was B, which I told you that DLP is a limited partnership, income passed to each partner and partner paid the personal level that I explained. Uh, Again, this is C. DG is general partner, does the unlimited liability in the partnership. How is the corporation? DG shareholders have limited liability for its losses and obligations. DAG-LP is 80% owned by DAG Inc. General partner that manages the partnership, right? And DAG Inc. is 30% owned by the D family, which holds several key management positions. So B is correct here. And then you go to the next question, which is two questions which are there. Then we have question number 4, where I told you that limited partners of DGLP are not shareholders of DG Inc. They don't have voting rights in the corporation. And question number 5, the D family can effectively control management of the timber and forest asset with only 24% ownership, right? So that should not be a problem, right? And how they can do is that they can always, the D family can effectively control management timber and forest asset only 24% because they can control the management, right? So if the family has opted for limited partnership at the organized form, they would likely need a much higher ownership stake to assert a management control and would have unlimited personal liability. B is incorrect. The double taxation problem is not an issue in the more complex pass-through. C is incorrect. Right, right, C is incorrect because the complex structure potentially creates problem because of existence of outside shareholders, right? So that's what we have, right? So yeah, fifth was A. It provides management control without the need for majority ownership of the family while maintaining liquidity, right? So that's it, guys. Just 5 questions, right? This chapter is very small, but if you're doing for the first time this chapter, you will be confused. Keep that in mind. Study slowly. Try to understand the difference between your all these features, right? Which is your proprietorship, your limited. Let's do the question. This will give you more idea. Again, let's do the question. Consider a firm with assets of 200. Okay, assets are given 200. Fully financed by equity, right? An analytical firm financed with 80% debt and 20% equity, right? So if I take equity only firm, right? Net income, what is their net income of equity only? Assume both firms have revenue over a period of 200, over a period of 200 and non-debt operating expense of 140. So again, net income is what? Revenue minus your operating expenses. Revenue was 200, operating expense was 140. So your net income is 60, right? Now, since it is all equity, right? And equity, the value of equity is what? The value of equity is 200, na? So if I have to calculate your ROE in this case, right, it is 60 by 200. Basically, net income by your equity. If this is equity only, if I am taking 80% debt firm, right, then please understand your interest, you have to also calculate interest is equal to what? 160 and interest rate 20% from the period. So 20% you have taken, which is 32 is the interest. Okay. Net income is equal to 60, which you got revenue minus OE, right? Net income you got, minus you have to do your 32 also, this interest also. So you get 28. But the point here is, what is the equity here? See, 80% is debt finance, right? So out of 200, 160 was debt, 40 was equity. So what is it? 28 by 40, which is 70%. Okay. So again, lesson we get here is leverage magnifies your return to equity. Till the time return on asset is greater than cost of capital, right? So that's what we understand. Again, same question, we have done it again, but go back, practice it. Next one. And same logic has been done here. If you see, they made a table, but I did directly. Right? This was 60 by 230. It was your subtraction 60. I took it 20 by 60, 60 by 30, 28, 28 by 47, right? And this is what we get. Then we have your practice question. So consider a firm with assets of 200 fully financed by equity and identical firm financed by 80% debt and 20% equity. Again, same. Both firms have revenue of 200 and so and so. Calculate return on equity for the period the firm experienced a 20% increase and decrease in revenue from question 1, assuming operating expense remains same. So again, the logic here is different. Now what we are saying is 20% increase in revenue, 20% decrease in revenue. So let's say in one case, 20% increase, let's say. If there 20% increase in revenue, 20% increase means 200 into your 1.2 becomes 240, right? So if it is equity only now, okay, so net income is equal to 240 minus 140 is equal to 100. So ROE is what? 100, or equity was what? Equity was 200, no? So 50%, right? If you are leveraged, net income is what? Net income is obviously your 100, whatever you got from here, minus 32, which is your interest, right? So it is 68. So ROE is what? 68 by 40 equal to 170, right? So massive upside for your equity holders. For your okay, this is one case, 20% increase in revenue. In case there are 20% decrease in revenue, what we will do? If there is a 20% decrease in revenue, if you have equity only, right? Net income, your 20, right? Okay. So ROE, right? ROE is equal to 10%, right? So you're not taking how are you getting a net income 20 if somebody is getting a doubt? You had 200 earlier, you're down by 20% means 0.8. So your revenue is 160. This is revenue. Your operating expense is 140. That brings net income 20. ROE 10%. Right? ROE 10% is what? Net income 20. Right? Divided by 200. That makes it 10%. There was less space, so I've done it quickly. If you are leveraged, is the only confusing piece in this chapter, guys. If a leverage, net income is equal to what? Obviously, 20 you have taken here. You still use the same 20, but minus 32 minus 12. 32 is the interest expense. ROE is what? Minus 12, right? But divided by what? Your equity, right? If your equity you are talking about, right? What will happen here is that equity is, what is the equity value, guys, here? Any thoughts? What should be the equity value here? 40, na? This was the 40, which was the equity value, na? Make it 30%. So tricky, right, guys? Please go back, understand it, right? Little tricky, but you have to solve this, right? This is the only difficult part here in this chapter, right? Same, look at the table. Tables are much beautiful, but again, in exam, you can't build the table. You have to do fast little bit. I have done that way, right? You can see 10% and 30%. Okay, leverage. Okay. Then another tricky question. These three are the only difficult questions in exam, guys. The rest are all easy stuff. I'm spending time here. This chapter is easy, right? Overall, till now, what we have seen is that debt lowers your WACC, that weighted average cost of capital, but increases your equity risk. Leverage amplifies your ROE, both upward and downward. Equity benefits from upside, you know, absorbs your downside. Debt holders gain no upside from your firm growth. Conflicts lead to your debt covenants. Equity behaves like call option of firm value, right? When we go to your question number 3, right? Another interesting question, right? So here you are considering a firm with assets of 200, financed by equity, analytical firm financed by 80. But again, same question. I'm not doing it again because it's same question. I think both firms have revenue or period 200, non-debt operation 140, same logic. Then the same all equity finance firm as in question 1, and its choices for financing a investment in, LT assets of 40. The particular details in the firm initial balance sheet are shown below. Revenues before the investment 200, spending expense 140, expected to remain unchanged. Calculate on new debt financing 20%, return on the new investment 30%. Calculate the ROE for the firm it finances the investment with debt. The issuance of new shares of cash on hand, compare the result, discuss the results of the comparative. Okay, long thing. We have discussed it already, half or them, or 75% of that, right? But let's read the answer. You have to go and practice. Basically, idea here is financing the investment with new shares uh, produce the lowest ROE among the 3 financing options. However, since the investment produced a return equal to the beginning ROE, there was no change in ROE from the initial case. So financing with debt produced a higher ROE because the interest rate on debt was lower than the return on the new investment and no new shares were issued. Highest ROE is produced by using excessive cash on hand, which avoid both dilution and interest rate also debt. Okay, remember this. Highest ROE using excess cash on hand. This answer is a little bit theoretical, so remember that, right? All right, so we have done the difficult part, guys. This was tricky. All right, let's do the question, guys. The company has developed a long-term relationship with its major supplier. The supplier has developed complex systems that integrate with those of the company and has agreement to receive payment within 30 days of period delivered. Discuss the supplier's stakeholder relationship with the firm. Why would a high financial leverage be inconsistent with supplier's mandate, right? Again, it's a discussion, not a MCQ kind of thing. So let's read the answer. The idea here is that supplier has a clear vested interest in the success and survival of the company, so it is considered a stakeholder. That is fine. The supplier extends short-term credit to the company and has a long-term interest in the success of the company because it is invested in integrated complex system. High financial leverage would not be the best interest of the supplier, that you remember. Right? That's why it is wrong, because it presents both short-term risk that the company may be unable to make payments for goods delivered, and long-term risk for the investment made to integrate the supplier complex system with those of the company, right? So as we discussed, right? High financial leverage, not good for supplier because it presents both your short-term risk and company may be unable to make payments for good in the longer run. Okay. Then we move on. Again, explanation question, nothing to worry. Explain why company's management might not act in the best interest of shareholder, right? Again, they are bound by certain rules and regulation which might be against the shareholders. So idea here is managers are in a principal agent relationship with the company shareholder. Managers overseen by the board of directors serve as agents who act in the best interest of company shareholder. However, in some cases, managers may put their own interest instead of shareholder interest. Example, including insufficient effort, failure to take appropriate risk, oversight by majority independence board, and compensation to align your manager's interest with shareholder. The performance-based and equity-based compensation schemes are mechanics to mitigate this conflict of interest, right? So alignment of behavior, performance-based, equity-based, right? These are mechanics to mitigate this conflict of interest. Okay. That's why we have solved the numerical. I told you, right? This is tricky. This will trouble you a lot. So, try to solving it at home, right? That's the idea. Okay. Etc. Right. This is like a story. Right. Just spend some time here and remember that highest ROE, right, is using excessive cash on hand. Right. Second highest is obviously by debt. Least highest is when you do it only with equity. Right. So that, and this calculation part, just be aware of that. Right.